Greetings, class. I wanted to talk about notes receivable that we didn't get to finish up in class, and I will on Monday night. But as far as the homework, I want to make sure you had this information. So we talked about accounts receivable. Now we'll move to notes receivable, which is a more formal agreement, and it's usually written where we've lent either an individual or another organization some money, and they promise to pay us back, so we're the ones that are actually going to receive it. It is a receivable, so we would be receiving the money back. So we would have a written promise from them to pay us back at the maturity date with interest at a stated interest rate. These are also called promissory notes. But again, remember the notes receivable is where we've lent the money to another entity or person, and we're going to be receiving the interest, which will become interest revenue, and we will be receiving the money back as far as the principal payment. So a couple different things that you can take a look at. It can be either current or long-term based on if it's 12 months or longer in the term itself. These are some of the terms. So the creditor would be us. We lent the money. The debtor would be the other party, either an individual or an organization. Interest is the cost of what the debtor has to pay in addition to the principal or what we actually lent them. Maturity date is just when everything must be paid by. Maturity value is, at least for this instance, the sum of both principal and interest. That's what they would be paying us at maturity, since they're not paying us monthly. Principal is the amount that the debtor borrowed, and then the term is the time frame that the note is. Can be any time, but it would be specified in the note. So let's look at the actual interest and how that's calculated in a little bit more detail. So interest for our examples is always paid at maturity. Not always the case because it's usually paid monthly, but at least for this accounting class, we're looking at it to be paid at maturity. The interest rates are always annualized. Annual percentage rate is APR, but annualized. And then sometimes we'll be looking at it, most of the time we'll be looking at it from a monthly basis. How many months of interest are we considering? So we do it as a fraction of how many months until either the end of the accounting period or the due date divided by the 12 months. And it's the same interest formula that we've been using. So we've got the face value, which is also the principal, times the annual interest rate times a fraction of the year will give you this. For homework problem 8 in Connect, you guys will need this, and it's just going to be a linear function or linear algebra as far as solving for the missing piece is what you're going to be looking for in that problem. So let's look at an actual example. So these will be the steps that we'll follow, but on 6/14, a $3,000 note was issued by us to another entity. We're going to be collecting 6% annual interest, and the note principal and interest are all due on 3/15. So remember, we got to look at these dates. So 6/1, we have to include June if we get to the end of the year, not if, when we get to the end of the year. So we need to prepare the original and the adjusting entry at the end of the year to recognize the interest that we will have not received but should have received, and the interest revenue. Remember, the adjusting entries are to recognize either revenues or expenses that we need to but have not actually been incurred at that point. So here are the steps. We need to recognize the original transaction. Then we also need to record the adjusting entry at year end to recognize the interest due our organization. Okay, so let's look at the first entry. So this is on 6/14. We will, notes receivable is a debit because it's an asset account for us, something that is owed to us, and we actually paid out the cash to whichever entity we lent it to. So we lent them the money, so our cash reduces. In exchange for that, they give us a promissory note or a note receivable that shows that they owe us that money plus the 6%. So that's the original transaction. Then the adjusting entry, we need to recognize the interest, so we're going to have to calculate the interest, and it's going to be based on the month. So we have 7 months until 12/31. So we need to go back and use that formula. So $3,000, 6%, and 7/12 is the formula that we would use. So 3,000 principal, 6% interest, annualized interest rate 7 months because we include June. So from 6/1 through 12/31, you have 7 months through the end of the year divided by 12 gives us $105 in interest that we should have received but did not because we're going to receive it at maturity. See, it says interest are all due 3/1/15. So we're going to debit interest receivable since we didn't receive it. It's actually a receivable, so we'll debit that. It's an increase to that account, meaning that we will receive it. And we also credit interest revenue because it is income for us at that point in time. So that's our adjusting entry, and we've completed what this one is looking for. So this is the second part where we're going to be looking at how do you do the final journal entry at the receipt of the final payment. So the information is the same. We've lent another institution or another individual cash, so we gave them cash. Our cash account went down, but they gave us a promissory note. So our notes receivable account went up. We're charging them 6% interest, and we will collect everything on 3/1/15. So that's what we're looking at. What actually happens on 3/1/15? So this is the steps at this point when we want to record the payment to us at maturity. So we're going to be receiving cash, so we need to figure out how much that is. But we'll figure that out based on all of these items. So we would debit the cash received back. We would close out the notes receivable. So we had opened the notes receivable with a $3,000 balance. So the notes receivable was opened with $3,000, so we need to close it out with the credit for $3,000. Step 3 is that we would recognize and record the interest revenue from the current period. So we're looking at this. So we still have 2 months worth of interest that we have not recognized at this point because we recognized through 12/31. So now we need to get us to March 1. So we still have 2 months worth of interest revenue that we need to recognize. So the same, it's the principal 3,000 times the annualized interest rate. 2 months gives us a $30 interest that we need to recognize as revenue because we're going to be receiving the cash on 3/30 or on 3/1/15. So that's the third step. The fourth step is to close out the interest receivable. We did this at the end of the year where we opened up an amount saying that we hadn't received the interest, but it was receivable. That was a debit. So we will be receiving the interest. So we will be receiving the interest in cash on 3/1/15. So we need to close out that receivable. So that's basically looking at the notes receivable as far as we lent somebody some money. We recognize the interest at the end of the year that we earned but had not received as of yet, and then a couple months later the note principal and the interest was paid to us. So that's the end of this tutorial.